Welcome to today's Explainer, where we're going to unpack a massive, fundamental shift happening right now in the global financial landscape. For a while now, there's been this really heavy tension hovering over the market when it comes to the future of legacy payments. As the tech world evolves at literally breakneck speed, a lot of investors have been asking a very serious question. Are the old guard payment processors quietly slipping into obsolescence? Well, today, we're diving into one of the biggest names in the business, Mastercard, and breaking down a pivot that might just redefine its entire future.
For the past couple of years, the narrative around companies like Mastercard has been heavily clouded by the fear of disruption. Ask yourself, is Mastercard becoming a dinosaur? Look at the sheer volume of threats they're dealing with on a daily basis. You've got the rapid adoption of stablecoins, threatening to just completely bypass traditional payment rails. You've got AI shopping agents, entirely changing how we discover and buy products. And of course, you have relentless mounting regulatory pressures globally. For a hot minute there, it genuinely looked like these legacy networks were sitting on borrowed time.
Okay, let's dive into this, because the script has completely flipped. The old narrative was purely defensive. It was basically Mastercard playing an endless game of whack-a-mole against disruption. But the new narrative? It is all about pivoting to dominate what we call agentic commerce. And listen, this isn't just some empty corporate buzzword. Legendary investor Bill Ackman recently made a massive, contrarian bet that completely reframes how we look at Mastercard. In his view, it's not some dinosaur waiting for the asteroid. It's actually the essential, unavoidable backbone of the future economy.
Section 1. The Agentic Commerce Play and Pershing Square's Bet. So, we recently witnessed a dramatic V-shaped recovery in Mastercard's stock right off its June lows, rocketing up to roughly $569. The major catalyst for that momentum? Pershing Square established a significant new position, aggressively betting that the rise of AI in commerce doesn't hurt Mastercard, it actually pours gasoline on their growth. To really grasp this, we have to understand what agentic commerce actually means. Basically, it involves AI agents making automated purchases on behalf of consumers. Imagine your AI assistant seamlessly buying your groceries, renewing subscriptions, or booking flights for you. But here's the absolute genius part. Every single one of those automated transactions still requires central identity verification and really robust fraud controls. Mastercard has planted itself right in the middle of this new automated flow through their value-added services, or VAS. They aren't just processing the payment anymore. They're verifying the AI.
Now, what's really interesting about this is the number 40%. Bill Ackman's thesis relies heavily on this exact figure. Mastercard's value-added services already account for roughly 40% of their total revenue. This isn't some distant 10 years down the line pipe dream. It's happening right now. And even more critically, this vast segment is growing 2 to 3 times faster than their core payment network. Actually, scratch that. It's more like they're rapidly transforming from a simple toll bridge into a highly sophisticated security and authentication fortress.
Section 2. The Financial Foundation. Let's look at the Q2 2026 results. So, are the numbers backing this up? The short answer is an emphatic yes. In Q2 2026, Mastercard reported an absolutely massive earnings per share of $5.04. That completely blew past Wall Street's estimate of $4.77, and they achieved this on $9.28 billion in revenue, which is a highly impressive 14.1% increase year over year. The fundamental growth engine here is clearly roaring.
But they aren't just sitting back and resting on their laurels. They're aggressively deploying capital. Take a look at their strategic $1.8 billion acquisition of BVNK. This is specifically designed to solidify their stablecoin infrastructure. And I think this brilliantly illustrates their proactive strategy. Remember those threats we talked about earlier? Well, instead of fighting the crypto disruption narrative, Mastercard simply bought the infrastructure to integrate it. It's a brilliant, direct hedge. It ensures that even if stablecoins become a massive medium of exchange, the transactions are still running straight through Mastercard's ecosystem.
Let's do a quick profitability check to see the real health of this machine. Yes, the stock trades at a relatively high price-to-earnings ratio of 31, but the forward PE drops to 28.5, which tells us the market is expecting some significant earnings growth ahead. But the numbers that should literally make your jaw drop are the margins. A net margin of over 46% and a staggering return on equity of 241%. To put that into perspective, those metrics prove unequivocally that Mastercard remains one of the world's most profitable companies, currently sitting just a mere 5% below its 52-week high of $601.
Section 3. Wall Street Sentiment. Let's follow the smart money and see how this builds.
Wall Street paints a very clear picture of overwhelming bullishness right now. Out of 41 major analysts covering the stock, we're looking at 29 strong buys, 9 buys, and just 3 holds. But you know what the most important takeaway here is? Out of 41 top-tier analysts, there are exactly 0 sell ratings. 0. The consensus on Wall Street is practically unanimous that this pivot is working.
Let's break down exactly what those analysts are projecting with their price targets. The average target sits at roughly $665, representing a very healthy 17% upside from recent trading levels. But look at the high-end revisions that happened right after Ackman announced his position. Bernstein hiked their target to $710. KBW bumped theirs to $685. And Bank of America? They're sitting at a very bullish $735. The smart money is aggressively pricing in the value of this agentic commerce pivot.
And the growth projections entirely back up those targets. Pershing Square projects a massive 18% annual EPS growth over the next few years. On top of that, Zacks Research just raised their full-year 2026 EPS forecast to $19.72, which sits right near the broader consensus of $19.82. Basically, all the data points we've covered so far support a narrative of highly consistent, high-teen earnings growth.
Section 4. Risks and Headwinds. Time for a reality check. So the crucial point here is understanding the elephant in the room. There are 2 major risks that could realistically clip Mastercard's wings. First is a massive legal overhang, and second are some genuine valuation concerns. Even though the GF value estimate suggests the stock might be undervalued, others point to a PEG ratio of 1.72. The argument here is super simple. You are undeniably paying a premium price for this growth. If Mastercard stumbles even slightly in their execution, that premium valuation could correct, and correct very sharply. To contextualize that legal overhang, just consider this number, $38 billion. That's billion with a B. That is the sheer scale of the merchant settlement over swipe fees. While Mastercard obviously has massive cash flow, a regulatory headache of this magnitude is a persistent, heavy drag. It's a stark reminder that while they are pioneering the future of AI payments, they're still heavily tethered to the fierce regulatory battles of the legacy credit card world.
We also need to note the internal sentiment. Recently, there's been over $15 million in CEO insider selling. Now look, executives sell stock for a whole variety of personal reasons, but it does suggest a degree of profit-taking at these current near all-time high levels. Furthermore, we've seen firms like Macquarie slightly trim their target to $665, citing some near-term cross-border transaction headwinds. It's just a reminder that macroeconomic factors still play a huge role in their daily volumes.
Section 5. The final verdict. Bargain or premium?
Let's return to that core tension we established at the start. To distill this whole analysis down, Mastercard is essentially a high-quality compounder trading at a fair price with a strategic upside catalyst. Yes, the price of entry is steep for sure, and yes, the regulatory burdens are massive, but the story has fundamentally shifted. If Mastercard continues to successfully execute on its AI-driven security and authentication services, growing that 40% VAS revenue even further, today's pricing might actually look like an absolute bargain in the rearview mirror. Which leaves us with one final provocative thought to consider as you digest this explainer. If AI agents truly become the primary shoppers of tomorrow, seamlessly navigating the internet to buy what we need, can you really afford to bet against the digital toll booth they all must pass through? Keep a very close eye on this one, you guys, because the future of commerce is being rewritten right before our eyes. Thanks so much for joining me, and keep learning.